So here I am at my sunny desk in Ithaca, New York. You can see we're adjacent to Cornell's baseball field and to Shokov Field, our football stadium. We're going to take a trip to Spain. Zooming out now, zooming into the north coast of Spain in just a moment. Here we come. Going past Barcelona for a moment, and we're going to go to the beautiful city of Blanes, which is along the Mediterranean coast. Notice the beautiful harbor with already some hotels shown in Google Earth, but notice that around the city there's some undeveloped sites for hotel development. That's our imaginary Spanish Playa Hotel. Imagine the sun-drenched Mediterranean coast. You have a site available for development. It's difficult to get the entitlements to build hotels, but once they get built, they seem to do quite well in this spectacular location. After rejecting the property 4 years ago, Property Development Corporation is ready to reconsider. Our protagonist, Morgan Avnati, has brought the project back for reconsideration to see if it is consistent with the firm's goals. Let's take a closer look from the perspective of the numbers. So, here we are looking at Exhibit B, which is the spreadsheet representing the proposed property performance for the Spanish Playa Hotel. Let's concentrate our view at the very top panel. One of the most important things to understand is that any new hotel that gets placed into a market has what's called a ramp-up period. We start the first year with a 55% occupancy, grows to 60, 65, and then with good business, we're projecting 68 and 69% occupancy. Our average rate starts out at 112 euros and is growing over time as well. Those are our primary revenue drivers. The quantity of rooms sold is represented by occupancy, and the price, which is represented by the average rate. Our revenues are shown below. 2.8 million of rooms revenue for the first year, roughly 950,000 of food revenue, roughly 488,000 of beverage revenue, 210 telecommunication and internet revenues, and then a small amount, 100,000 euro of rentals and other income, for a total $4.5 million of revenue in the first year. I promise you I won't be reading every number on this slide. Big picture is the hotel has a income before fixed charges, otherwise known in the industry as gross operating profit, about 1.6 million on a $4.5 million revenue base, which is a 36.5% margin. Going lower in the income statement, we see that our net operating income, which is the cash flow from the business, is roughly 1.64 million euro, or 25.4% of revenues. Here are a couple of things to focus on as you review the spreadsheet. And I want to note that as the property starts into stabilization from year one until year three, note that not only the net operating income growing from 1.16 million in the first year to 1.69 million in the third year, note that the margin improves from 25.4% to 30.9% as the occupancy grows. As a matter of fact, our margin grows to 32.9%, almost 33% by the time we get to year 5 with a 69% occupancy. This is one of the defining characteristics of a lodging operation, which has a high level of fixed costs and a fairly low level of variable cost. So as the occupancy increases, the operation itself becomes more and more profitable. So here we are looking at the actual Spanish Playa Hotel spreadsheet. There are 3 tabs on this spreadsheet: an assumptions tab, a cash flow tab, and a valuation tab. What we're going to do is walk through all 3 to see how the spreadsheet's set up, and then how the owner would do the evaluation based on those numbers. So here we have a short description of the hotel itself. It talks about the 125-room Spanish Playa Hotel, mid-market beach hotel to be built on the Spanish coast. This hotel, we think, will cost 17,500,000 euros to build, or approximately 140,000 euro per key. We'll be modeling a 10-year hold, and we have an investor that has a required rate of return of 10%. That is, unless this property produces a return of at least 10%, our investor is not interested in investing. Not only do we obtain the cash flow from operation over our holding period for 10 years, we have the option to sell the hotel at the end of the 10th year. The way the investment analysis works is we put together a simulated sale at the end of the 10th year to capture the value that's been created over the 10 years of operation. We think we'll sell the hotel for 12.5 times the net operating income, or NOI, and there will be approximately a 2% selling expenses associated with this sale. So that's our initial assumptions. Now let's take a look at our operating cash flows. A little bit smaller resolution here to get everything on the full screen. I have year 1 through year 11. What I've done here is replicate our occupancy and average daily rate from the Exhibit B spreadsheet. Note we have $4.5 million of revenue in the first year and 1.16 million euro of net operating income in the first year. Note again that our occupancy grows from 55% in the first year to 69% in year 5. But here I'm modeling a cycle. Our occupancy turns down in year 6, 7, 8, we're as low as 61%, and then we rise again with a cycle to 63% in year 9, and then 65% in year 10 and 11. Our cash flows, 1.16 in the first year, grow to approximately 2.0 million, or 2 million euro, plus by the end of the holding period. You can see we put in some metrics about percentage changes of revenue and percentage change of cash flow in the first few years. Note how sensitive this operation is to the changes in revenue. Note that in year 1 we have a roughly 9.38% increase in revenue, but a 22% increase in cash flow. Similarly, the second year, roughly 8.96 or 9% increase in revenue, and again 18.85% increase in profitability. That's the good news when things are getting better. However, when things get worse, let's take a look at year 7 as an example. We have a 1.06%, roughly 1% drop in revenues, but we have a 5.5% drop in our profitability. This shows the sensitivity of these operations to changes in their occupancy. Lastly, let's turn our attention to the simulated sale at the end of the 10th year. In the 10th year, we feel we'll sell this hotel for 12.5 times the cash flows anticipated in the year following the sale. That would be the $2 million expected in year 11, so there it is, $2,059,059 times 12.5. We think we can sell this hotel for 25 million or 25.7 million 10 years from now. Note what we're doing. We'll build this hotel for 17.5 million. We'll sell 10 years later for 25 million, net of some expenses of roughly €500,000. So that's our cash flows. Now we're ready to do our analysis.